Well, thanks a lot for doing this, guys. First, I really appreciated you taking time out of your day. So with us, we have Danielle Neziol from BMO ETFs and Chris Heakes from BMO ETFs. So you guys actually manage and deal with the BMO ETFs on a day-to-day basis, right? So maybe just quickly give us a rundown of what you guys do for BMO ETFs real quick before we get the questions started.
Sure. Maybe I'll jump in and get started. So
sure.
I've been with BMO for almost 5 years. So I used to work on the product side. So I would actually work on a team that brought ETFs to market. We work with the exchanges to get them listed. And I'm excited to answer some questions about the distributions that came in because that was part of my role there as well. I've moved over now. I'm working specifically on focusing on bringing ETF education to direct investors like yourself and like people who are watching this channel, which is really exciting because we're noticing so many more direct investors are opening up accounts and using ETFs and going online to educate and empower themselves to manage their own money. So that's kind of how my role has shifted at BMO.
Excellent. What about you, Chris?
Yeah, thanks, Adriano. So my name's Chris Heakes, and I'm a portfolio manager at BMO ETFs. So I help take care of the day-to-day management of various ETFs, mostly covered calls, which I know we're going to talk a lot about today, and I'm excited about that. And also a couple others like low volatility and dividends. So I've been with the team since 2011, and that was the year we launched our first covered call ETF, the ZWB, the bank's ETF. So it was great to be here and look forward to the conversation.
Perfect. Thanks a lot, guys. Appreciate it. So we'll get started with some easy questions first. Obviously, you guys know what my channel is all about, passive income investing. So the focus is really on those covered call ETFs because myself and my audience, we really invest for passive income, and those covered calls ETFs are really perfect for that. So the first question I would say, or is really in 30 seconds, maybe, can you guys describe in your own words, more for newer investors, newer people who have no idea what these ETFs are, what is a covered call ETF and what type of investor are they designed for?
Sure, I'll take this one, Adrian. So a covered call ETF, this is basically an ETF that uses an enhanced income strategy. So we write call options on a portfolio of stocks. And this really provides investors with two sources of income to get that enhanced income. So you get those option premiums, but you also get dividend income as well. And then these combined can create really attractive yields, 5-6% or north of that, which investors are really kind of searching for. And another reason that they're so popular is that this income is actually quite tax efficient. So back in the day, investors had to look to fixed income to get income for their portfolios. But as we know, in this rate environment, rates have gotten so low that fixed income really isn't providing high yields like it used to. But the fixed income side of the portfolio, it's also not as tax efficient because that income that comes from fixed income is taxed in the income account. Whereas the option premiums that you get from a covered call ETF, they're taxed as capital gains.
Right.
And then the dividend income is taxed as dividends. So a very tax efficient, enhanced yield product that investors can access. It's really cost efficient as well.
Yeah. Well, that's a great explanation. I think I must have said those words and like a million times in my videos. So that's great. Thanks, Danielle. So how did you guys become the biggest covered call ETF manager in Canada? We all know that BMO, in terms of AUM, assets under management, you guys have the biggest covered, assets under covered call. So how did that go about? How did that happen?
Yeah, so it started back in 2011. That's when we launched our first one. And kind of what was happening in the market is we were just coming out of that great financial crash of kind of 08, 09. And one of the big themes in the market then was, the search for yield. They're calling it the search for yield. And obviously, when you're looking to generate yield in portfolios, covered calls are just a perfect match to do that. And so as a consequence, the strategy synced up with a theme, like just to a perfect level. And then I think what's happened since then is that search for yield, which was a big theme coming out of the crash, never has gone away and continues to be, a major theme. So we've been able to capitalize, and just kind of grow the lineup, grow the strategies as we've gone along. I think one thing that really helped us, not only being first in Canada to launch covered calls, but we've always tried to do it in a real kind of balanced ways. So obviously we want income, but we also want exposure to the upside of the stocks. So to do it in a disciplined way, deliver a good return experience for investors, both total return as well as high income return. I think people have just looked to us as, the firm you want to partner with in the space. So I think doing it the right way also helped us, as well as kind of first to launch them in Canada.
Yeah, thanks for that, Chris. Yeah, I mean, the thing I usually tell my audience about covered calls, and what I try to explain to people who are kind of new to this, is that covered calls is nothing new. Options are nothing new, right? They've been around since what, I think the 60s, correct me if I'm wrong, when options started coming about. But it's more these funds that do the covered calls that are a bit newer. And as far as I could tell, the first ones all came out in 2011, starting with, like you said, ZWB and just some other providers. Though the earliest ones that I've seen in terms of just covered call ETFs came out in 2011. And like you said, for the reason of people need yield, right, in this low interest rate environment, right? So, and yeah, sorry, you were going to say something?
No, I just wanted to, just to reinforce your point, like, it was a new investment product, or it was new to be in an ETF or a fund in 2011, but a lot of people really like the covered call strategy. But one reason I think it also took off a lot as an ETF is just that one click, kind of one, ease of access, call it. We've got now about 10 covered call overlays. We've got hundreds of options on at any one given time, and we've built up a business to take care of it. So, it's a great strategy, but I think what a lot of people did before there was the ETFs is they said, well, it's a lot of work to manage. But that's where, the asset management function comes in and can just give that ease of access.
Yeah.
So for you and your followers, people think like that our customers, it's a very easy ticket to access, and we manage it in the background. So that also helps.
Yeah, and another thing I mention all the time is that you could do your own covered calls. You could buy the stocks individually, write all the covered calls yourself. I haven't even attempted it because it looks so time consuming and complicated to me. So that's why for me, these ETFs are amazing. It's really, you're kind of getting that service, right? So that brings me into the next question. So talking about more in terms of BMO specific covered call strategy. So as we know, there's really two important things when it comes to the covered call strategy, right? The coverage of the portfolio, how much portfolio you write the calls on, and the moneyness of the options. So what's BMO's covered call strategy in terms of those two factors, and why did you guys choose that for BMO?
Yeah, I think the big thing we think about when we're making those decisions is it's a balance, it's a trade-off. So there's a trade-off between income and growth. So you can generate a ton of income. You can generate 10, 20% plus income if you want, depending on how you structure that option overlay. But you'll be giving up so much upside, or you could be just eroding your capital base. So for us, it's finding that right trade-off between income and growth. And the way we do that is we just, on our portfolio, we just sell options on a half of it. So if you get that really strong up market, and generally speaking, the last 10 years have been very good equity markets, half of that portfolio fully participates in 100% in that growth. So we cover half of the portfolio. And then on the part that we do use options, we use out of the money options. And we really let the market dictate to us how we can get that, what the most attractive way is to generate the income. So I'd say across our mandates, on average, we're trying to raise that income level by 3 to 4%. So let's say like a ZWC, a high dividend Canadian equities, they're yielding 4, call it. We want to add another 3 to 4% through the options. The biggest component to that is actually the market dynamics. So if the market's really volatile, like it was around COVID, we could sell those options 10, 15% out of the money. So if the stock's at $100, we'll sell that strike at $115. And the way we look at it is we get the income that we want, and we give investors as much upside, as we possibly can. So it's a very non-greedy approach. Now, when volatility comes down a bit, we're a little closer to the money, but we never go at the money because we always want to have exposure to upside. So even at the very narrowest, we'll be at least 2% out of the money on a month-to-month basis. So at least stocks can go up a bit and you get full participation. So it's a lot of thinking involved, but we think, by having that right mix of covering half and utilizing out of the money options in a kind of a defensive way, a way that ensures maximum participation, that gets us to a good spot where we can deliver these products really sustainably, offer that increased income, but also give it that ability to grow over time.
Okay, so you guys always do out of the money, and as we know, the more out of the money they are, the less of a chance they're going to be exercised, so the more the growth potential you capture, right? So in case any of my viewers are not so it's aware of that. So it's basically a very, like you said perfectly, a non-greedy approach, right? It's probably one of the
absolutely
right. So that's
yeah, it's absolutely non-greedy, and Yeah, I think when you get greedy, sometimes that's when things can get a little bit messy from an investment point of view. So it's always, it's sustainable, something we can do, it's repeatable.
Yeah.
And that's what it's all about, I think, for us.
Yeah, I agree. That's perfect. And to be honest with you, the number one criticism I always get on my investing strategy, because it's the bread and butter is really the covered calls. The main concern is always capital erosion. So I think if that's your main concern, I would always suggest the BMO ETFs, because in my opinion, they're probably the least greedy out of all the fund managers. And you just confirmed that, right? So yeah, that's very important. All right, thanks for that. So let's get into how these ETFs are built, or how do you guys choose what companies or what stocks to put in ETFs? What do you base your decisions on? What kind of research? I'm sure you guys have a research team and you look at that. So how do you guys decide?
Yeah, well, like we were saying, Danielle was our research team when she was with the product team, but it's a collective effort. Really, we understand all covered call investors want income, but in terms of where do we start with those underlying stocks, we have to make an assessment of where do we think people are most interested, what adds the most value for investors. I think starting with Canadian banks, was kind of a no-brainer, because obviously we work at banks, maybe we're a little biased, but they do have a great historical return profile. They've got a great history of dividend growth. Given that a lot of investors are in covered calls for income, we not always, but generally having a really strong dividend base has been a feature of some of our most notable products. So it started with banks. We had a little bit later we had utilities, also a sector that has higher dividend yields. So ZWU, very high yield there, and we launched. It kind of evolved as time went on. We launched dividend-based portfolios. Like I mentioned, ZWC a second ago. So Canada, the US, ZWH, Europe, ZWE, we have a ZWG global. Now we have different currency options. So, broadly diversified dividend portfolios have resonated with investors. And, we've launched some other newer strategies like technology as well, trying to turn technology. And maybe this is a year where technology is wobbling a little bit this year to start the year. Maybe a covered call approach can add some value this year. So it's a constant, kind of just trying to find what fits the best, what's going to add the most value for investors, and take it from there.
Okay, cool. Yeah, I know that you guys have a lot of dividend theme, a lot of your covered call, like the Canada one, the Europe one, the global one. It says dividend in the word, so in the title. So like you said, you guys seem to be focusing a little bit more on the dividend stock. So covered calls, dividends, put that together, and like you mentioned earlier, you get your 5, 6, 7% yield, right? Which is great. That's awesome. So all right, so now I think I want to get into the harder questions for you guys. So these are the next couple of questions are the ones where my audience really wants to that's the ones that are the most popular, the most in demand, that they want to see. So the distributions. So as you know, distributions for people living off the income like myself, for income investors, for retirees, the consistent distribution amounts, it's the most important thing by far. So how are the distribution amounts actually decided? What factors do you consider when you're trying to figure out what's the monthly distribution for this fund versus this fund, et cetera?
Sure. So Adrian, when we look at a covered call ETF, we're getting income from two sources. So we're getting that option yield that comes from the premiums that Chris's team is writing, and then we're getting that dividend income as well. And then there's also a fee attached to an ETF. So don't forget that. So the fee that you're quoted, the management fee or the MER, that's an annual fee. So a little bit of the fee comes off. You can think about it every day or every time you get a distribution, a little bit of that fee will come off as well. It's usually quite small though, if you look, because ETFs are so competitively priced, right? So if you look at our cover call suite, management expense ratios are around 71 basis points. That's 0.71%. So if you look at an ETF that pays out monthly, you just take that number divided by 12. It's about 5 or 6 basis points that comes off, but very minimal considering you're getting that nice big option premium and that dividend income as well. So we will pay out what we're earning. That's how it works. But you have to keep in mind, and I think this is really important for investors to think about, option premiums will change every month because they're very dependent on market volatility, and how they're priced is totally dependent on what the market is going to give them based on that market volatility. So if you rewind back to 2020, throughout the crisis of the early days of the pandemic, Chris and his team were getting very, very healthy option premiums because volatility was so high. And that was reflected reflected in the distribution. Now we're seeing volatility come down a bit. And so that's reflected. So if you see certain tickers, and I know there were some that were called out, like ZWK, back in the summer, we pulled it back a penny per month. I think it was from 10 cents to 9 cents. That's really just a direct reflection of what's going on in the market. And if we were to keep paying out that 10 cents, for example, and not have pulled it back, what we're going to be doing is now we're actually would have been paying out more than the ETF is earning. And you can kind of get into some trouble there. We call this NAV erosion, or you mentioned it earlier, Adrian, kind of like eroding your capital, right, your capital's growth. And this is something we don't want to do at BMO. We only want to pay out what we're earning and what the reflection of the market is. And we don't want to be eroding NAV. Now, investors should be aware when they're getting into these high yielding cover or products, ETF products, whether they're cover call or other types. Just do a little investigation on that yield. Make sure it's sustainable and it's actually coming from dividends and option premium, because there are some providers out there that want that big yield because it's a nice sticker price on an ETF, but they might actually be paying out some of the NAV or the net asset value to maintain that yield. It's not sustainable. So when you see a distribution drop from an ETF that's BMO, and it's usually quite small, like a penny per month, just keep in mind, think about, okay, well, what's going on in the market? Oh, volatility has pulled back. Maybe that's where the pullback is coming from.
Yeah, that's perfect. And I tell my audience all the time, volatility is good for the covered call strategy. This is a reason why I always preach all the time. I don't really care about market volatility. I'm going to embrace the next market crash because I know if I have all covered call stuff, the premiums are going to be rich. So thanks for that explanation. It kind of confirms what I've been saying. It's great. The next question was, you kind of already touched on this, a little bit more specific. You already touched on ZWK, but ZWC and the Europe one, they've all had lowered the distribution all by a penny, whereas some like the US one stayed the same. So is it basically because of exactly the factors that you said? The volatility has gone down, so the premiums have gone down. Is that the same deal for why those particular ETFs went down?
Yeah, that's what we're seeing. And the dividends coming from these portfolios have actually been fairly consistent. Now, I know back in 2020 there were some dividend cuts, but now we're seeing those normalize and get back to normal. So when you're seeing things change right now, it's probably a reflection of volatility. And then just keep in mind that every ETF's options or its portfolio is affected by volatility at different times in the market. So ZWK is US banks, and we know that US banks are more volatile than Canadian banks.
Right.
So differences in volatility there would affect a US bank portfolio differently than a Canadian bank portfolio. And again, we don't want to over distribute and eat into these funds' growth. So we're very, very deliberate in how we're managing these and reviewing them. And we just want to be fair and honest and pay out what the market is reflecting. Okay,
perfect. So when it comes to trying to decide when to increase, when to decrease, how often is it reviewed by you and your team? Is it on a monthly basis? Is it on a quarterly basis? How do you guys figure that out as a team at BMO?
Yeah, so for anything that pays out monthly, so our suite of cover call ETFs are all monthly distributions. We review it monthly, and we'll set it monthly, the distribution. And we really want to keep the distribution the same. That is actually one of our main goals, because we want that really good user experience for an investor. So what they're getting every month, they can rely on it and they can know that's coming in. But again, we don't want to be paying out more than what we're earning. And that's really important as well. So we do review it every month for these ETFs. The ETFs that are paid out quarterly, we'll review those quarterly. And we press release it every month as well. And we post that on our website so investors can see exactly what they're getting.
Perfect, thanks. And another question that just came to mind, you were kind of talking about it earlier, erosion of capital. A question I get all the time, and that's pretty valid for covered call ETFs, is the return of capital. Now, a lot of the covered call ETFs, and really all ETFs in general, could have a portion of their income as return of capital. When a newer investor looks up the definition, right away it's a negative connotation. They think it's just their money coming back and return to them. I have several videos to try to explain otherwise. what's your take, or I would say, how can you reassure investors that return of capital is not necessarily a bad thing, because it could be based on prior losses, et cetera, et cetera. So what would you say to an investor that has concerns about rock income?
Yeah, that's a good one, because rock income sometimes scares investors a bit, but with cover calls, we actually expect it. We expect it. And remember, that's part of the tax efficiency of it. And that comes from those option premiums as well. But if it was coming from NAV erosion, that's something harder for an investor to sort out on a tax slip. They wouldn't necessarily be able to differentiate the two. So again, it would take a little bit more digging to ensure that that rock is actually good rock and not bad rock. And it would just take a little extra education and reading on, if one ETF is similar to another and it's getting 5% more, there's just a little bit of questioning there. Are they writing more closer to the money, or is this coming out of NAV? Just something, always kind of consider those things.
Yeah, that's why it's important to always check not only the stock price, but in my opinion, the NAV price is the most important thing when you're investing in any type of fund. So thanks for that. I appreciate that. So what about covered call popularity? So are they getting higher and higher in demand? I know a lot of your funds have passed $1 billion, right? ZWB is the biggest. C is over $1 billion. ZWU is over $1 billion. I mean, these are massive, massive funds getting popular. So is the demand for these products rising, you think?
Yeah, I'll take that one. You know what it is, and like I said, it's kind of that search for yield. Like I said, was an investment theme in 2011. I think it's as much an investment theme now as it was then, and in some ways even more so. With lower fixed income yields. Now we're looking at a year now where fixed income yields are going to be coming up a little bit. And as they eventually come up more, they'll be like marginally more attractive, but relatively low for when people are looking to generate that 5, 6, 7% plus out of their portfolio. Fixed income, you're either going to take a ton of credit risk, which you may or may not want, or you just can't get there with fixed income yields. So, to your point, the banks, ZWB, ZWC, ZWU have been some of our most popular products really over the last year. Clients, individual clients, advisors, they want to participate in this economic reopening trade. Canadian banks, like I said before, they've been real solid kind of performers or historically. And then when you kind of add in that extra income, I think it can do a lot for portfolios. So, there's been steady growth kind of since day one. There's a real big pickup on the initial when we first launched. Response was very strong, and then it's been steady. And now, even now, I think it's another leg up as people kind of continue to put these into portfolios and get them working for them.
Okay, cool. And covered call ETFs in general, who would you think that they're best for? In my opinion, it's really people, we say hunting for yield, hunting for income, but in my opinion, it's really something great for retirees. I always say that, and a lot of my audience members are people that are about to retire, and I know a lot of them switch from growth investing to income investing and getting into these covered call ETFs that have rich dividends. So do you think that these are really great for people who want to retire early, people that are trying to join the FIRE movement, and retirees? Who do you think these covered call ETFs are best for?
Yeah, I think you kind of hit the nail on the head when you're thinking about growth investors versus income investors. It's really for that person, there's going to be some growth with the equities, but someone more on that, mix of growth and income, and maybe even a little more tilt towards the income.
Yeah.
And, that often characterizes retirees, whether they're, 65 or 35, who want a source of income. This can be a great way to do it. I think you look traditionally, retirees went to the fixed income market because, I think I bought my first GIC, and it was yielding double digits. My first GIC, I think, yielded 11%. Well, GICs don't yield 11% anymore. So, when in reality now, to generate income, you have to go to other asset classes, including equities. And again, covered calls is a great way to access that income. If you look at a covered call versus just a straight equity, because of that covered call approach tends to lower the volatility a little bit as well. So there's a little bit benefit there. So yeah, and generally speaking, people with an income need, and that's often retirees.
Yeah.
It can be a good fit for those styles of investors.
Yeah, I have a lot of my audience are retirees or people who are about to retire, and sometimes they do have an issue because I talk and meet with a lot of them via social media platforms or just YouTube comments. A lot of them have really trouble letting go of their single stocks their growth ETFs, because I'm always encouraging them, get out of that. Now is the perfect time. Equities all-time high. It's a perfect time to transition into the covered call ETFs, but they're emotionally attached. They're hesitant. What do you tell? I know what I tell them, but I want to know what you guys would try to tell them to maybe alleviate their fears. Someone who's looking to switch and they're hesitant. What would you tell them?
Yeah, I mean, I think, for me, you have to maybe take a step back. And, I think a lot of us with individual equities probably are sitting on pretty good gains. And you say, well, it's worked in the past. But you always have to say, well, what's your plan for the next 10 years, next 20 years? And, maybe that includes individual equities, maybe it doesn't. Some of the best things about ETFs is, again, professional money management. As Danielle said, very attractive costs. We can solve issues for investors such as income. So, there's I don't think for me, there's not a one size fits all answer, but definitely, like you said, you don't want to be ever tied to a specific way of thinking. Have an open mind to how different products like ETFs can help, give you a better, more well-rounded portfolio, perhaps better diversification, better income, so I would say definitely have an open mind to that.
Yeah, maybe I'll just jump in. I think a lot of investors are really focused on managing their returns, but you also have to think about managing your risk. And those are the two important things you have to think about when you're managing your portfolio. And the return side, well, that's the fun side, right? But think about how much risk is right for you to take on. And if you're retired or your investment time horizon is shorter or whatever the case may be, perhaps single stocks or a concentrated portfolio of single stocks, that might be too much risk for what your tolerance should be. And so I think investors just need to make those considerations. And when they turn to products like ETFs, you're getting immediate diversification. And then ETFs like covered call ETFs, which are a little more defensive and a little more lower down in the risk spectrum when we look at equities. It really helps investors manage the risk aspect of their portfolios.
Music to my ears, honestly. This is what I keep saying, because single stocks, you have a single point of failure, right? And what I usually tell them, besides what you just said, that the covered calls is really a defensive strategy, plus you get instant diversification instead of holding them individually, is that what usually does the trick mentally for them is that you're still going to have exposure to Pfizer and TD Bank, BMO, and you're just getting indirect exposure to them. So just because you're selling off your babies, you're still going to have exposure to the same stocks. You're just getting more defensive exposure. So it's exactly like you said, less risk because it's professionally managed, less time consuming, right? And add the defense with the covered calls. And, for me, it's a no-brainer, but a lot of people have trouble letting go. So thanks for that. I appreciate it. Hopefully people will realize that as well when they watch this. So next, just a few more questions left. I know I'm keeping you guys for quite a while here, but I got a couple left. This question is kind of, I've thought of this question before. It's always been in the back of my head. I want to see what the professionals think about this. Am I wrong in stating, because I've stated this before, that covered call income or covered call options income is an infinite source of income, right? I mean, there's some fear that somebody asked me the other day, actually a couple of people, what if these funds get so big and there's so much inundation of covered calls that the premiums disappear? Or is that even possible? Is it really infinite? Or what do you guys think about that?
Yeah, well, I think infinity is a long time, so maybe we're not going to make that claim. But I think what we're trying to get at here are these sustainable? Are these yields sustainable? And I can speak from BMO's perspective and our approach. And I know Chris touched on this. We are looking very closely at the stocks that we're writing calls on. We're not just chasing the highest dividend companies just because they pay a high dividend or the best option premiums. We're really, really mindful about our approach because we want these to be sustainable. We want investors to have a really good user experience and those cash flows to be consistent year after year because we really know people depend on them. So when we think about that, and we can go back to our high dividend approach when we're looking at dividend stocks, we really look at companies who not only pay higher dividends than their peers, but are growing their dividends year after year. And those are sustainable dividends. And this is a really important approach because if we were just looking at a company who is just paying a very high dividend in the short term, but they have a lot of debt on their balance sheet, and in fact won't have the cash flow to pay that dividend out in the future, we're going to screen those companies out to make sure that we have the highest quality dividend payers. so that these cash flows can be sustainable and they won't disappear down the road and shock investors. So I think from that perspective, when you're looking at someone like BMO, where this is kind of our approach, this high quality approach, we really aim to keep these cash flows very sustainable for years to come.
Right, like you said, non-greedy approach. What's your take on it, Chris? What do you think of covered call options? Do you think that they will last for hundreds of years? There's always going to be options to be harvested?
Yeah, well, yeah, it's a great question. I think, as big as these funds are, like ZWB is closing in on 3 billion. As you mentioned, we've got a few other 1 billion funds. Keep in mind that's still relative to the overall size of these cumulative market caps of all these companies, relatively small. So there's, it's quite a robust market. There's people in the option markets, not just covered calls, but there's other people hedging structured products. There's other investors who want to go long certain companies. Other investors want to buy puts to, to hedge that way. So there's a lot of players in the market, and it's a very robust market. There's a lot of room for growth. Part of what we do as an ETF provider, whether it's a covered call strategy or simply any strategy, is we make sure it's a robust solution for investors, something that has the capacity to grow and to grow. Something where, we're not going to run into like liquidity challenges. So that's something we look at, and we adapt the way we run things to take care of the liquidity. But I think there's lots of room for growth. We're not at the ceiling by any means. Getting some of the portfolios are certainly getting big, and the market appreciation is helping with that. But yeah, no real problem. And like Danielle said, if you're doing things the right way, doing them sustainably, I don't know if I'll say infinity, but things are looking good for a very long time, right? If we're doing things right year after year after year, the timeline is, the launch pad is looking long on this one. So definitely feel good about our lineup as it is, and as it continues to grow.
Yeah, that's very reassuring. And I was actually thinking about it the other day. Why do people buy covered calls? And the most obvious one is, if you're bullish on a stock, you buy a covered call. But then there's, like you mentioned a bit, the fund managers hedging or whatever. People also buy covered calls to buy insurance on something they're shorting, right? Just like someone would buy a put for the opposite, right? So there's different reasons why people buy those covered calls. And another thing that reassures me, tell me what you think about this, is that the markets seem to be getting, I don't know if it's because of AI trading and more retail investors are getting into it, they're getting more and more volatile. If you look at the VIX, it's kind of getting a little bit more volatile. So that's good for covered calls. That's good for the options market, right? Correct me if I'm wrong.
You're right. You're 100% right. Traditionally, the number one trade in the option market was people buying puts. So to your point, when you buy an option, you're buying volatility. So that was the number one thing. Now, U.S. option markets in particular have had record volumes. Coming off 2021 was a record year. And what you're seeing is, like you said, a lot of retail investors. And again, mostly they are buying calls to the upside. So when you have a large segments of the market buying calls, it's a supply and demand thing, like anything else. So the more buyers there are, tends to be better for the sellers. And so from that point of view, the put buyers were always a dominant force in the market. Now retail call buying is becoming more dominant. So again, it gives sellers, a good healthy market in which to sell options.
That's great. That's reassuring. Thanks for that. Appreciate that. Yeah. Next question. You guys already kind of touched on this, but the BMO Yields, so the BMO covered call ETF yields, they're typically lower than some of your competitors out there, like Harvest, CI, maybe not all of them, but and you guys kind of touched it, you have a non-greedy approach. So what makes the BMO covered call ETFs different from your competitors?
Yeah, so I think, our unique blend of covering half the portfolio, but also using the out of the money options. Using the out of the money options in particular is something that can reduce your yield a little bit, but it just gives you better upside potential. So it comes down to how you want to solve this trade-off between income and growth. And, we want every stock in our portfolio, whether it has an option or not, the ability to grow, and if it has a covered call, the growth is limited to the strike plus the income you receive. Right. And then on the portions that aren't covered, it has, an unlimited upside profile. So that's what it comes down to. And so again, like I would agree, it's a non-greedy approach on the option side. Then circling back to the underlying equities, You know, and it's maybe not always the case with our competitors, but I would say generally speaking, our equities tend to be a little more defensive in nature. So we have Canadian banks, we have high quality dividend paying stocks, utilities as another example. So again, it's just that more defensive stocks gives you a more, you know, to Danielle's point, you know, like a better controls your risk, but because they're a little less risky by nature, you know, maybe you don't get extreme option premiums. And lastly, like Danielle said, we have, you know, a very important focus on not over distributing. We want these things to be, you know, built to last to, you know, years and decades and decades and decades, right? So that's, I think, put them all together, and we just try and put something out that's very reasonable and compelling, and it's, you know, like I said, built to last and sustainable.
Perfect. Thanks for that. Yeah, you hear that, guys. So if ever you're worried about capital erosion, and I'm talking to my audience here, if you really want a little bit of growth as well as decent income, you know, the BMO ones are really probably your best option, and that's what I think, and you guys are just confirming that too. So okay, cool. I want to talk about almost done here. I want to talk about two of the, I don't know if we consider them covered call ETFs, but they're certainly, you know, the ones at the two at the bottom of the list, ZPW and ZPAY. Now, I made a video a while ago. I cover the best safety ETFs because, in my opinion, GICs, fixed income, don't get mad at me for saying this, I think it's a waste of time. It's sacrilege for me. For me, it's like disrespecting money. So my audience, I tell them, look, if you really want something safe, go with these. You know, these two ETFs are perfect. So what made you? Can you describe what these ETFs do in your own words? I mean, they're not exactly, they do options, but they're, you know, the risk rating you put on them is low to medium instead of medium like the rest. How do they work?
Sure. Okay. So just for those who don't know the ticker symbol, so ZPAY is our premium yield ETF, and then ZPW or ZPW is our put right ETF. So these ETFs, they use options, but they use put options, which are a little different than the cover call, but the same idea. You're getting those premiums paid every month, and that's the source of income. So maybe I'll just answer about the safety of them. So when investors get out of the fixed income spectrum and they go into equities, these aren't fixed income replacements. And I just want to be clear on that, because you are in equities now. Yes. So you have a little more risk. Now, something like ZPAY, the premium yield ETF, if you look at the equity spectrum, it's much lower risk than even maybe a cover call would be. And then you can kind of go up the risk spectrum from there all the way to equities and index funds and sector ETFs. So when you look at it from the equity perspective, yes, it is much lower risk. And there's a few reasons for this. So I'll cover ZPAY to start, and then I'll get into ZPW. Sure. So ZPAY, what we're doing is we're writing put options, and we're writing put options on a basket of very high quality blue chip US equities. We do a screen on these. We make sure that they're good blue chip stocks. They're stocks that we'd like to own. So we write these put options. And what a put option is, for investors out there that are unfamiliar, we're selling insurance on a stock basically to another investor. And if the stock falls below a certain price that's predetermined, we'll buy that stock from that investor who purchased that option. And they're purchasing that option, they're paying us a premium to do so. So this will effectively stop the losses for that investor who's holding that stock. On our side of the trade, we'll buy that stock. And we actually, because we do such a high quality screen on these stocks that we're writing put options on, we're actually quite happy to buy it if it goes down in price. And we're talking about stocks like Visa, MasterCard, Meta, formerly known as Facebook, Johnson & Johnson, Apple. So these are stocks that if they pull back, 10% or 5%, we're comfortable purchasing them. Now, we also then write call options on these stocks. So when they rebound and start to rally, we'll capture a bit of growth. And then when that call option goes into the money, then we sell it away to the investor who's on the other side of that trade. So what this really does is it enhances the income for the investor by you're getting option premiums on calls and puts. But it's now limiting the growth side of the equation. So you're getting a little more income, much less growth. So that's kind of the trade-off on that product. And then for ZPW, this is just a put right ETF. So we're writing puts on the portfolio of US equities, but there's no calls on that. So and then going to your question about risk classification. So when we determine the risk on an ETF, this is something that's actually regulated by the OSC, the Ontario Securities Commission, and we have to go by their rules. There's no way around it. So we look at what's called standard deviation. So this is a measure of volatility, and we look back 10 years on that ETF. And if the ETF doesn't have 10 years, we have to find an index that's very close to the performance of that ETF. And we look at that 10-year volatility history, and then we're given certain thresholds where we can rate it accordingly. So something like a ZPAY, I think it's low to medium risk because of the way the portfolio is structured.
Yeah, that's a perfect explanation. And by the way, Genius Fund, I love those two funds. I always push them in terms of, I could be wrong in saying it because it's just my opinion, but safety ETFs, how I try to explain it, and correct me if I'm wrong here, it is equities, but it's less correlated to what the stock market does. So I always try to explain it to people this way. Let's say the stock market crashes 20%, well, something like ZPAY, ZPW will go down maybe 10% because most of the holdings is actually cash, right? If you actually click on the holdings and look, the biggest percentage is cash. And like you said, the ZPAY one especially, it holds some stocks. The put one doesn't. You just have the stocks that you're forced to buy. But the stocks in ZPAY, they're very, very defensive. Like you said, Visa, MasterCard, mostly healthcare, there's consumer staples. So that's right. You're doing defense on top of defense. So am I correct in saying that it's kind of less correlated to what the stock market does?
Yeah, you're right. You're absolutely right. It's lower correlated to a broad equity ETF, and that's because of the cash balance. So something like ZPAY, because we're writing those puts, we have to hold some cash. If the puts go into the money, we're going to be buying equity. And so that cash balance is going to shift very dynamically based on what's going on in the stock market. And a really good example is in 2020, ZPAY dropped much less than the S&P 500 or an S&P 500 ETF because it had so much cash in it. Now, then all the puts went into the money, it started buying up equities. Then it would sell them off as markets rallied. So now the S&P 500 is doing better than ZPAY because, of course, ZPAY is back to having that cash balance. But again, the whole time providing those consistent cash flows. So that's what the investors are looking for rather than that growth. Yeah.
I mean, I love ZPAY, and to be honest, I don't own it myself personally because I rather go with the ZPW, but just as a stupid information, it's the #1 position in my grandparents' portfolio that I now manage. So
I love hearing that.
Yeah, I mean, they've been investing in GICs their whole lives. And I think just a year ago, they finally agreed to let me take over. And they've gone from 1% yield a year or even less than that to 6 to 7. And they love me even more. So it's a win-win.
If that's even possible, Adrian.
If that's even possible. Yeah, I don't think it is, but just as an FYI, that's how much I have full confidence in things like ZPAY and ZPW. It's really, for me, it's a no-brainer in terms of a lot lower risk, very stable 6%. Don't put your money in GICs. Put it in something like ZPAY. You'll get 5 times your return, right? So that's what anyway, fun fact for you guys. So yeah, I think we're coming to the end of it. So I do have maybe 2 questions that audience members added or really begged me to ask you guys. So I'll start with the first one. Any plans for an all-in-one type solution? So there's Hamilton ETFs came out with HDIV, which is a collection of covered call ETFs from different providers. One of your competitors, Harvest, just announced a prospectus that they're doing an all-in-one solution with their own covered call ETFs. It's called HDIF with an F. What about you guys? Are you guys thinking of an all-in-one just to put all the BMO covered calls in there together and make one fund, or even doing that and putting some leverage on it or something like that?
Well, it's not in the works yet. And leverage is something we haven't looked at, although, we're always looking to evolve with the market and look where demand is going. But we did in our asset allocation ETF suite, we do have ZMI, which is a monthly income ETF. Now it's around 40% fixed income and 60% equity. It holds a couple of our covered call ETFs, I think ZWG and ZPAY. It holds some of our dividend ETFs, ZDV, ZDI, and ZDY. So it's Canada, US International Dividend in the equity part of the portfolio. And then it has some fixed income ETFs as well. There's a preferred shared ETF in there. It's yielding around 4%, which is, it might be a little bit lower than some of the other products out there. And that's just because of that fixed income allocation is pulling in a little bit less. But again, for investors who do need that fixed income allocation, that need that stability, and a 60-40 split, something they're looking for, there's an ETF that holds, several higher, on the equity side, higher dividend paying or higher premium ETFs. And what's great about it is we priced it the same as all our asset allocation ETFs. So it's 18 basis points management fee, but it's holding some of those covered calls that we know are 65 basis points. And even the dividend ones are, I think, around 20 or 35. So it's, I think, a very competitive pricing on that for what you're getting.
Okay, so maybe in the future, I mean, talking about leverage, you guys are a bank, so a big bank, so you must have the cheapest, you could get the cheapest leverage ever, right? So anyway, just food for thought. I mean, I would definitely be interested in one of those if ever you guys come out with it. Maybe like an 8% target yield or something like that.
We'll bring it back to the team. We'll bring it back. We'll do some reconnaissance.
That's cool. Awesome. And last question. So BMO is, obviously a big bank. They have a broker investor line. We kind of talked about this earlier. And they offer a lot of commission-free ETFs on the BMO ones, but it seems like some audience members who use it say that the covered call ones are not commission-free. So what do you guys say about that? Is that in the works as well? I'm sure it's not. I don't think it's you guys yourselves that handle that, but.
So I think it's something we'd love to see as well. We are talking to Investor Line. We can't, Chris and I can't totally control. We can lobby for it though. So we'll bring that back to the team at Investor Line.
Much appreciated. I'm sure the audience will.
It's a sign of a good conversation that hopefully the good feedback goes both ways. So we'll definitely take that back. And so commission-free trading at BMO Investor Line is still relatively new. It just came out with it about 6 months or so ago, but it's nice to see. Speaking as someone in the ETF industry, those commission-free trading is great. So it's great to see Investor Line doing it, and we'll take your feedback, and I'll certainly advocate for it because I'd love to see some more of those options available.
Perfect. Appreciate that. That's the end of my questions, guys. I really, really appreciate your time. If there's anything you would like to add, anything you want to mention, feel free or talk about, you could go ahead right now before we wrap up.
I just want to say thanks so much for the support. It's because of people like you out there that are educating and empowering investors. I think that's really great. So thanks to everyone for their questions and for tuning in.
Appreciate that. So, all right. Well, hopefully we'll do something again soon. Maybe we'll do other collaborations in the future. If ever you guys come out with a new fund, especially a covered call fund, let me know right away. I'll let the audience know, because that's what my channel is all about. We're just always on the hunt for new funds that use options and that have high yields. So thanks again, guys, for coming. I really, really appreciate it.
Thank you.
Awesome. Thanks for having us. It's great to be here.
Thank you. Thanks for watching, guys. I really appreciate it. So I hope you enjoyed this interview, this Q&A session with BMO. It was certainly fun for me because I got to really show you guys or collaborate with some professionals here, all the stuff I've been preaching about on my channel, right? So please hit that like button if you enjoyed the interview. I would really appreciate it. It helps the channel grow. It's a win-win. So please hit that like button. I would appreciate it. And also, if you like this type of content, make sure you subscribe to my channel and hit that little notification bell, because I have more fund manager interviews coming up. Very, very exciting stuff. I have 2 of them lined up, and I'm in talks with several other fund managers to really give you some Q&A videos with them and discussions with them and talk about their funds. So it's very, very exciting for me to really bring you this great content. So make sure you're subscribed not to miss out when these videos come out in the near future. Also, make sure to check out our website, of course, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 3 right now. I'm very proud of this digital product. It's a reference tool or a companion tool to really help you build your own portfolio according to your needs. It has lists of funds, sample portfolios for every kind of different investing style, and it's good for Canadians and Americans. I have 7 Canadian sample portfolios, 7 US sample portfolios, and I'm always going to keep growing this product, adding more sample portfolios. So that's where the lifetime updates come in. So you only need to purchase this product once, as it comes with lifetime updates. So make sure to pick it up. It's a really cool product. Also, on my website, right there on the homepage, you'll find all the information. I offer a one-on-one consultation service for more personalized help. If you want more personalized help, it's a one-on-one 1-hour Zoom meeting with yours truly, myself, to really, I'll answer all your questions. You could ask me whatever you want. I'll analyze your situation. I'll help you build a portfolio, transition to an income portfolio, whatever your needs are, I'll do my best to help you. So make sure to check out my website. All the information is there. I know my appointments sell out very, very quickly, so make sure you check out that little message on top of the calendar to get the current status of the appointments. Also, join us on social media. We have a Facebook group. Join us there. You could follow us on Instagram if you want to know more personalized about our everyday life. So we share more personal stuff there. So follow us on those social media platforms if you use them. My mission, the mission of this channel, guys, will always remain the same. It's to help everyday normal working people to invest on their own so they could build their own stream of passive income to enhance their quality of life. So with that, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.